Welcome back to Reporter's Diary. To our big exclusive, Yes Bank came out with its first quarter earnings today, and the private lender managed to deliver a healthy set of numbers in the quarter gone by. While there's nothing to complain about on the net interest margin, credit cost, loan growth, or for that matter also the bottom line, what can be seen as a touch of bother is a slight hiccup in the asset quality, which saw a slight uptick in the gross NPA number, while the slippages number came in at 300 crore rupees. Lata Venkatesh joins us now with the MD and CEO of Yes Bank, Rana Kapoor. Lata, over to you.
Well, Arundhati, first I must take issue with you. Even on asset quality, you cannot fault Yes Bank if the gross NPAs have risen from 0.76 to 0.79. The difference is practically indistinguishable, and that really is the distinguishing point of this bank, exposed to the corporate sector. And while many other or most other corporate-facing banks have been reeling with higher and higher bad loans, Yes Bank has singularly escaped all that. Mr. Kapoor, welcome to the show, and first of all, congratulations. One has to admit that this is a very good performance from the bank.
Thanks very much. I really appreciate the fact that you recognize it and that you're correcting the asset quality, wrong interpretation.
Let me come first of all to the growth. Asset quality is not a problem with Yes Bank, and I'll look for some details later on. But a 33% interest loan growth is a very impressive number at a time when growth is scarce. Is this repeatable?
No, Lata, it's a very interesting observation, because if you see last year, which was a very tough year, fiscal 15-16, we grew the loan book at 30%.
Yes.
The fact is that, our overall denominator is still like a medium-sized bank, which is now leaning towards a small, large bank, right? So our growth last year was 30%, and we have reason to believe that with the sectoral and fairly well fine-tuned, segmented, geographic, as well as sectoral strategies, we have reason to believe that we can address the credit demand in some sectors, which is resurfacing. Also,
so this 33 is manageable.
No, I think 33 is not sustainable beyond like a point, but we have reason to believe that next 4 years, which is the third phase of Yes Bank's life cycle of growth, from a small large bank into a medium large bank till 2020, we have reason to believe that we can sustain between 27 to 30% credit growth. And because of the sectoral strategies we have, there's reason to believe that with good credit filters, relationship management, intensified product, penetration, that this can be done.
Okay, so if you can tell me where the growth came from, where this 33% came from.
If you see, fundamentally the growth is coming in from the sectors we focused on literally from inception. Some of them continue to be sunrise sectors, like agribusiness. We have reason to believe that in renewable energy, we have a fairly significant market share, apart from substantial market and mind share in that particular business.
But broadly, is it corporate, retail, SME, MSME?
I think it's the engines are all moving, because the interesting thing is that the corporate businesses give us an opportunity because of a proven track record and a relative resilience in asset quality, give us an opportunity with that proven track record to build market share and mind share. At the same time, all the growth engines in what we like to believe in our SME businesses, which is not small anymore, is 23% of our total advances. And if you look at even the consumer and commercial retail, which is clubbed as retail banking, is almost inching up to double digits. It's about 11%. So with the overall branch banking driven growth and strong growth in retail liabilities, and with credit cards, which is the final last minute product launch, we are going to be a very comprehensive retail bank in this year.
Okay, well, maybe credit cards is not something you will feel the absence of once the unified payment interface is up and running. But let me come to other income. That has contributed substantially to your profit. It straight away goes to the bottom line. And the notes to accounts gave us very broad ideas that it comes from guarantees, letters of credit, financial advisory, selling of products. Can you give me a breakup? Did a substantial amount come from sale of securities, investments?
You see, overall, if you look at the composition of our earnings in this quarter, we were approximately 60% driven by net interest income.
Yes, of
and
course.
broadly, just around 40% by non-interest income.
Yes.
This was a very good quarter because what we are seeing is increased market share on corporate banking and in corporate finance. The reason is that, our branch that we set up in Gandhinagar in the international banking unit, that's giving us new breakthroughs in clients like pharmaceutical sector, which was difficult to compete with when we did not have an offshore loan book.
So how much was fees and how much was, say, sale of securities or profit
Sale
booking?
of security is not a very large number. It's about 140 crores. And but at the same time, it's a number which we believe in the course of this year, with the interest rate outlook, will be meaningful. And we will use this number to maybe add to our contingency reserves in course of time. And that's the whole idea, that not everything should be booked to P&L, but should also be, in a way, allocated towards building gradually a contingency reserve as well.
Okay. How much of equity dilution will come because of the QIP, you think? What are you prepared for as an upper limit?
You see, when we discussed this only 3 months ago, I had shared with you that we expect overall dilution of around 12 to 13.5%. So I will pretty much stick to the number, maybe 12 to 13%. The fact of the matter is that the continued resilience of the asset quality of the bank, the sustained profitability of the bank, increased market share of the bank, the outreach of retail and branch banking is in a way helping to re-rate the bank. And we've had a soft landing on asset quality.
Obviously it has helped you to re-rate. When I last spoke to you, you were a 900 rupee share. Today you are a 1200 rupee share. No way.
Maybe you are the good luck factor.
No. It's certainly the numbers. No, if it is a 12 to 13% equity dilution, your ROE at the moment is about 21%.
Approximately.
How many months will it take, or how many quarters will it take to come back to 21?
It's very interesting because when we meet investors, this question comes up invariably in every meeting. We are equity capital raising for us, for a bank like ours, and I'll give you 2-3 reasons for this, is value and earnings accretive from day one.
Okay.
So we have reason to believe that give or take 6 to 8 quarters, we can restore ROE back to 20%. And at the same time, because our ROE is at 20% and our dividend payout policy is about 80% retention and 20% dividend payout, that in itself gets us about 20% of organic growth through retention of profits. So the incremental capital that comes in is going to help us to grow at 30%. And with that, we can become ROE, let's say, competitive in less than 6 to 8 quarters.
Okay, that's truly impressive. NIMS...
We've done it in the past. If you see our 2010 capital raise, $225 million. Within 4 to 5 quarters, we were back to 20%. If you look at our $500 million capital raise in May of 2014, which was a very big success, it's doubled in value since then. That also enabled us to get back to 20% ROE, actually in less than, 8 quarters.
Okay.
So it's value and earnings equity.
Okay. Let me see if I'll have time for nitty-gritties like margins. But the bigger vision is, will you be wanting to take over, do some buying up of, say, a microfinance or a small bank? We just saw IDFC do that. And that small bank business is fairly lucrative. Look at the way Equitas and Ujjivan are doing. Will inorganic be a thought?
Lata, I must confess that, the DNA of Yes Bank, which has been, in a way, personifying itself over the last almost 12 years, is driven by hardcore entrepreneurship, what we call professional entrepreneurship. So the ability to create building blocks within the bank, to make them profitable within reasonable time frames, is the real entrepreneurial joy of our top management. So yes, we will look at, acquisitions as and when they come through, but there is a fair amount of organic capacity, bandwidth, bench strength the bank has to be able to build businesses organically. We are building a securities business as a subsidiary, which is going to be more in retail, broking and asset management. In course of time, we got a license. So our ability as a bank with a professional DNA as the Professional Bank of India is really organic, because I'll tell you very honestly, what happens is HR in India needs to be very homogeneous.
I agree.
And sometimes when you address it and you put a shock in the system, it can take a couple of years to like recuperate, right? The systems have to synergize. The IT has to be like very, friendly on the interfaces involved. So a bank like ours, which is still like a brand new bank, even though we are 12 years old, has the ability to engineer new businesses organically.
So your preference is going to be organic?
Prefer that, more weightage on that. But if there is a very, very sweetheart deal, but why not?
Okay. Well, just wanted to know about the asset quality, since I don't want to not look at that piece as well. There will always be one or two skeptics out there who would feel that, if you're growing 33% at a time when the economy is still difficult, have you become a little more, shall I say, courageous in lending? So what are your self-given targets on NPLs? Do you think you will go maximum to 0.8 or 0.9? How might the subsequent quarters look like?
No, it's a very good question, because, the guidance on gross is that we should not exceed 1%.
Okay.
And we have a minimum provisioning policy, literally of 60%. And right now our overall provisioning coverage is 64.2%. So, which means net we should not fall or increase net NPAs beyond 40%. At the same time, there is a lot of focus and visibility on recovery of losses, recovery of NPAs, reducing restructurings. As you will see in our numbers, we have made significant progress in reducing, restructurings overall.
Yes.
In sale of assets to, ARCs, security receipts. When you look at the totality of asset quality, I can promise you today we are outperforming the perceived retail banks in the country.
Well, you have made a very strong case for a re-rating of the bank to the level that the retail banks are
We're
getting.
AA plus rated, but we want to be AAA, but I'm sure you're talking in an equity context.
Yes, certainly. Mr. Kapoor, it's a pleasure speaking with you. Thank you very much for joining us. And I hope that things are going to be as good as they have been over the last several quarters.
Right. Thank you.
Okay, back to you, Arundhati. As you can see, Yes Bank, very, very enviable targets. 30% growth in loans expected, and even when they raise equity, which they have to provide raw material for growth, the ROE is likely to come back in, maybe 6 quarters. That's a very enviable performance. Back to you.
Thank you so much for that, Lata. Yes, indeed, it was a good quarter for Yes Bank. And staying with the earnings, India's largest mortgage lender, HDFC,